It's PB Fintech in the spotlight, and they have reported a profit for the first time ever. Ajay Sharma caught up with Yashish Dahiya as well as Alok Bansal of PB Fintech.
See, we on our business, we have about 40 to 45% contribution margin. What that means is every time we do 1 rupee of extra revenue, 40 to 45 of it comes into contribution. And below that is our fixed costs. And I think that is what is called operating leverage. That as your business expands, you contribute some amount to it. So if you look at the first 9 months, our revenue has expanded by about 500 crores. But of that 500 crores, 170 crores has flowed directly into the EBITDA. And I think that's what's telling, right? That 34% of your revenue is flowing directly into EBITDA. That's what's called leverage. So as you scale, you become more and more profitable. One thing which is very clear, if you take a 9-month view, don't look at it just quarter by quarter. This is not a profitability which has been achieved by controlling costs. So sales costs, marketing costs, nothing has been brought down. It's a very straightforward business in that respect. The second thing that happens is as time progresses, because the brand is evolving, consumers' trust is evolving, the conversion rates keep improving, our technology efforts are higher, our efforts on creating better products are higher, better products and better insurance products for consumers. So the conversion rate slowly keeps inching upwards. We are not disclosing, but the premium per inquiry is the way we look at it, is significantly higher than what it was last year, which was significantly higher than what it was last year, right? And I think that means that every year you're getting more and more efficient. Now, this year, actually, if you ask me, our profit and our contribution is understated by about 2%. And that is because health has grown a little faster, by a 20% faster than the growth of the overall business. So if the overall business has grown by X, health has grown by X plus 20. And in the first year, we make zero contribution on health because health is a renewals revenue business. And so if you really think about it, if health is 25% of our business and we grow 20% faster, so you got a 5% additional growth on health. You're a 40% contribution business, but on health, you're making zero. So you're losing 40% on 5%, which is roughly 2%, right? And that is exactly why our EBITDA is actually, so if instead of health, we had grown on all our other products in a combined manner, our EBITDA would have been 2% of revenue higher, which is about, on 870 odd crores, that's whatever it is. But that's broadly the difference. And that's the real ingredient. The second part is renewals. As you get older, your renewals become larger and they contribute, they have a higher margin than fresh business because you put in a lot of effort in fresh business. You cannot get renewals without fresh business, of course. And as I said, in health, we don't even make money on the first year, right? Because you have put in all the effort and you hope that the customer will stay with you for a long time and so that you will reap the rewards of your effort over the coming years. So yeah, it's really that.
Yashish, just a quick follow-up on that point, which you spoke about, operating leverage. It has started kicking in. Do you see this? The beauty about operating leverage is that once it starts, it only gains momentum. So can we assume in your phase of the business also that it started kicking in? It may only, the momentum may accelerate in the next coming quarters. Is it okay to assume that?
I think a very critical thing that people should watch out for, is look at the last 7 quarters and see how much has, for the core business, right? Leave out the new initiatives. For the core business, how has EBITDA moved? And you will notice it has increased by more than 50 crores every quarter year on year. So that means for the year, it's always grown by more than 200 crores. Now, that is the operating leverage. So as you said, once operating leverage kicks in, it has been kicking in for the last 2 years. And our core businesses have not just been profitable, our core businesses are significantly profitable. They have about 12, 13%, EBITDA margin right now. Now, the reason why our profitability got delayed were 2. First of all, we started new initiatives at IPO. Most companies were trying to go towards profit. We were moving away from profit because we felt new initiatives were very critical for the long term of our business. So we actually expanded losses through new initiatives. Our losses on new initiatives, even this year, will be almost 200 crores. So what am I explaining? We have made profits despite 200 crores of losses on new initiatives. So the core business is at 200 crore profit already, right? And I think that is what is the real mix here. Of course, as they mature, new initiatives stop making smaller and smaller losses also. So it becomes a kind of, double treat. The third aspect is our ESOPs. Because of accounting treatment, they were stated as very high in the past. And we had pointed this out that as time progresses, they will become lesser and lesser, less and less critical or less and less. So that is also playing out. So all these three factors will lead to, in my opinion, higher and higher profitability as time progresses.
Excellent. That's good news for shareholders. Alok, now that this major milestone has been achieved this quarter, the profitability, it stands out. Is it okay to assume, many of the shareholders are talking about it already, that the 1,000 crore profit guidance which you had given, that may actually be achieved earlier than estimated? Are we moving fast towards that? Would you like to
No,
stick to it, give some timelines?
nothing of that sort. See, we have delivered 1 quarter of profit right now, and the journey from here to 1,000 crore is still, takes 2-3 years time frame. It's very tough to predict that it will happen a quarter earlier or a quarter later, but we're very, very focused as a team that we continue to do what we are doing today in more and more efficient way. We've always maintained that profit in our business was inevitable. It was just residing in the back book. What is most important is that eventually the business needs to grow faster. It needs to solve for the customer's problem. It needs to create better book of business for our partners. If we continue to focus on these fundamentals, I don't think profitability was a very, very big concern. Anyone who understood our business, and we would not like to change our sort of guidance that we had given that we want to achieve 1,000 crore PAT profitability in FY27. We will stick to it right now.
Alok, at the top management level with this kind of a performance under the belt for the quarter, the kind of commentary which we are hearing from you all, what will be the strategic areas of focus if one were to talk about, say, 3 to 4 quarters far out from between now and the next 1 year?
See, in our, it depends on what you call strategy. Our business changes every few years. If you really think about our business, when we started, we were an advertising and marketing company. We were mostly lead generators for insurance companies. Later on, we became a sales company. We became a fulfillment company. Then we became a data company. Then we became a tech company. Then we became a data company. And this may not be visible from outside, but from inside, when the insurance companies deal with us, they see that change every 2 to 3 years. So we keep changing along that path. And we'll keep getting deeper on that path, right? Our job is to serve our customers more and more. We have got, in the last couple of years, what you have seen is a heavy push on claims assistance, etc., etc. We have applied for an account aggregator license. We are, in the process of thinking about payment aggregation. We have applied for, a reinsurance brokerage license. All of these are signs of where we will evolve to and how we will make our business deeper. We have an investment in Visit Health already, which is an outpatient and a healthcare portal. So we are also making progress on that. We already own 40% of that company. So these are all strategic pieces coming in. So what you will see us do is get deeper and deeper with the, on our services and control more and more of our service layer so we can give a better experience to our consumers. Of course, that will mean you will control a little more of the value chain one way or the other, or influence a little more of the value chain. But what we will not do is we will not ever compete with our partners. So we will not become an insurance company. We will not become an NBFC. That's really how we will operate.
Alok, how are things shaping up at Paisabazaar? You had indicated earlier that the growth will be slightly slower there. How are things shaping up? Because there is also a regulatory glare out there at the speed at which consumer loans, especially unsecured ones, are being dispensed.
Yes, you're absolutely right. See, we were never part of the huge growth. So we never grew 200, 300% a year, right? We were always growing at 50%, 40% a year. And that story has been consistent for the last 15, 16 years. So, as they say, when a big shift happens, everybody gets impacted. So yes, the regulator has raised concerns about personal loans. While, as I said, we don't do the sub 50,000 rupee personal loans. We are mostly in the 2 lakh, 3 lakh rupee personal loans category. But even lenders cannot even be seen to be, business as usual. When a regulator points out that, look, I think there's something that you must look at. So the boards of companies have to look at it, even though they do not see anything immediately, right, in our portfolio. And so that implies there is obviously a slowdown in pretty much all the partners. Plus, there is a cost, an incremental cost of lending on the personal loan side. So that does, temper the market a little bit. And as I said, 10% lower growth. So if we were growing at 40, we'll grow at 30. I think that's how we think about it. If we were last quarter, we grew at 36, we may grow at 26 for the next quarter. I'm not, we can't be that specific with guidance, but that's broadly how we see it. We also expect it to be a quick one. The reason we expect it to be a quick one is I think we are 1 month into it, probably it'll last another 2-3 months, is because we see, look, how do banks make money? They have to, unsecured loans is a great way to make money. And eventually everybody is sitting on large bases of deposits. So they have to come back on this. And there we can see lots of new entrants coming in here. And we think it obviously takes time in onboarding new partners and in getting existing partners to become aggressive again. But I think we should see that by the end of this quarter.
All right, there you have it. That's the view coming in from the management of PB Fintech, and they're talking about how they are looking at profitability, which has not only been achieved by controlling costs, but a contribution that has been understated due to faster growth in the overall health. Losses for the new initiatives, though, that has accumulated to about 200 crores, and their profitability will only inch higher. No wonder then that you're seeing that kind of a reaction on the stock price. 1014 as it's scaling and moving from strength to strength in trade today.